Hey everybody, Marty Mazzora here, Tuesday the 30th of November 2023 with your midweek market snapshot. Clients, this will be your Wednesday morning message when you receive it. Today, I once again, I'm going to talk about stocks. We'll do the usual, S&P 500, NASDAQ 100 ETF. We'll look at small caps and we'll look at yields and the dollar and see how those technical patterns I've been talking about are starting to play out. First, I want to take you through a few years of history where we had the kinds of Novembers that we just had. Now, I do want to preface this by saying, folks, it is not my intent to be always bearish here on the blog. I am more than looking forward to a point, and that day will come, when I show you mostly, if not nothing but, bullish patterns, bullish conditions, and sounding a very bullish tone on here. For now, that narrative just really isn't available to me. And so what I want to do, really for the benefit of clients, is to express why we're stubborn in our hedging right now and being relatively defensive in terms of our allocation. And for just the rest of you who watch these videos, while indeed we could see quite the melt up in December. In fact, I think that's a legitimate base case. If you think about the year that we just had, you think about the seasonality, you think about professionals needing to, catch up as much as they can by year end, that sort of thing. But as I showed you last time, the technicals have really deteriorated of late. In fact, if it weren't for the seasonality and the end of year window dressing type stuff, I would probably say it's unambiguously bearish. Okay, so again, I want to look at year to date through November. The first chart here is this year, right? So after a pretty notable third quarter sell-off, in the matter of weeks, we've pretty much made that back. Pretty impressive, right? So 2023, November 30th. Okay, so obviously the years that I'm going to show you are where a robust or a strong November didn't necessarily work out when you fast forward to the same time a year later. So here is the 2021, pretty good run right up to close to the end, last few days of the month, and then it actually rolled over during the month of November. 2019, really good November, right, as well. 2007, mid-November on, quite the spike up. So the month of November ended up positive after it continued to melt down there for a while. And again, I'm gonna pull these all forward here in a second. Pretty strong November right back here in 2002. I'm certain people were thinking that the worst was over at that point. And then going into the tech bubble, 1998, 1999. So as you can see, it's really strong November 1999, even after sell-off in the last few days. Okay, so obviously we can't fast forward the first chart because that's today, but let's go to the 2021 chart, and I'll just type in 2022. Just a rousing December, right? Big Santa Claus rally, and you can see what happened after that. I think peak to trough, it was about a 27% decline. And then 2019. Fast forward to the same time, 2020, and of course that's where we suffered the COVID shock right in here, and then it's wonders what trillions of dollars of stimulus can do to basically create a virtually once ever 35 to 40% decline amid a recession, and then never a retest of that level. So again, we do live in unique times, and it is having unique consequences in terms of lags between recession signals and recession, if indeed we're going to have one, that sort of thing. Then the 2007 scenario, go a year later to 2008, kind of meandered around a little bit during December before we fell off the proverbial cliff, so to speak. And then 2002, pushing that forward a year. So there's your November rally. As you can see, December didn't happen. We actually had a down December, and then came careening down and finally finished for good here after March 11th of 2003. The 1999 scenario, fast forward a year. Monster December, January, February were rough, came back, peaked for the final time right in here, ended up with a 50% decline from there. when it was all said and done. Okay, so my point being, when macro conditions, when our PWA index, for example, still gives us a recession signal, that's not a time when we're going to significantly add to our positioning, even when the seasonality looks as good as it does right here. And just for context, a lot of people, including myself, are painting some parallels between now and the tech bubble. So there's your 1999 chart, and then here is your 2023 chart again. Peaked here around July, had the big correction, came roaring back through November 1999. You can see the peak was the same time here, and here we are again, folks. History in no way, shape, or form has to repeat itself. A la Mark Twain, it often rhymes. The setup, in other ways, it does concern us to some degree similar to 1999. The concentration among a few stocks happens to be technology stocks, happen to be at super high priced earnings ratios, that sort of thing. So anyway, history during times when conditions are like this gives us strong reasons to maybe not dive in on what is right now a very bullish narrative for the end of the year. Most people believe that it's going to be strong, and it certainly shows up in the sentiment numbers. Okay, so as for the technicals, remember I said the market's looking very heavy. You can see that we're technically still in overbought territory, kind of dipped out of it and dipped back into it today. And when we have these patterns, you have these overbought conditions, and either bearish divergences or waning momentum, right? And that shows up in the pattern and in these indicators. It would make some sense for the market to pause. Let's look at the hourly really quick. Broke out sideways out of this channel, but we still have these very notable bearish divergences, so it's just not a good looking short-term setup for certain. And then on the NASDAQ 100 index, the QQQs, or the ETF that tracks it, you can see we're still just dancing right on top of that line that captures the high in July. From a momentum standpoint, just not a good look. About to get your sell signal on the MACD, starting to roll over here on the RSI as well. So again, not a good look for the NASDAQ 100. And then really quickly, small caps, the Russell 2000 index. Here's the daily chart. You can see that we're still kind of moving up in this. It could be a continuation pattern. Typically, it would be bullish if you get confirmation on the momentum indicators. I mentioned that you had resistance at the 50% Fibonacci retracement and the 200-day moving average. This would be what you call a shooting star. Just giving you this candlestick jargon. This would be more of a graveyard doji, as they call it. Another one. So this shows that there's a real fading of small caps, and it's fading right up against this resistance right here. So we'll see how it goes. A break below here, and you could see it easily pop down here to the 1775 range, which is that next retracement level, if not below. Again, I keep coming back and thinking about seasonality, and it'll be very interesting to see as the calendar rolls over tomorrow and into next week. If Chairman Powell says market-friendly things tomorrow, I suspect we'll get a pretty strong rally out of it. But right now, just looking through the charts, there's reasons to doubt the Santa Claus narrative right here. Again, not saying it's not going to happen, just saying there's reasons to doubt it. Okay, so beyond just the stock charts, I mentioned that getting a bullish looking pattern here on yield, on the 10-year yield, and sure enough, it did drop below that yesterday, but it popped back today, closed off the highs, but the 10-year yield definitely rallied today. That means bonds in price took a pretty good hit. I'm intermediate to longer term actually bullish on bonds, bearish on yields, because we think that there's a good chance that a recession comes. But technically speaking right now, it does look like the market's setting up for a spike in bond yields. Typically, we would expect that to be supported by perhaps hawkish Fed talk by Powell tomorrow, and then generally decent data throughout the next couple of weeks or so. So we'll see how that plays out. And then really bullish look for the dollar. A rising dollar right here would not be good, nor would rising yields. If that's going to be the December look, those are two massive headwinds for equities. Next few weeks, of course, are going to be very interesting to chart for you here. as I said on the written blog, the next few weeks I'm going to spend less time on the blog, certainly. And when I'm there, they'll be on the written blog. There'll be much smaller blog posts because right now I'm basically putting together all of my notes, gathering my thoughts, collecting the data to express what I want to express in our lengthy year-end message and then give it to you over the course of the last couple of weeks of the year. Thank you as always for watching and listening. Talk to you again soon. Bye-bye.